Somebody will announce it? Any announcements or?
Oh, yes. That's it. Maybe you can introduce everyone.
So tell me when to start.
Yeah. 5, 4, 3, 2, 1, go.
Good evening, everyone, and thank you for joining us for HCLTech's FY24 annual results press conference. Today I am joined by our CFO, Pratik Agarwal, our Chief People Officer, Ram, and our Global Head of Financial Services, Srini Sheshadri. And I'm joined by Anil Ganju, who handles a large part of our Americas portfolio, which consists of telecom, media, publishing, tech, and retail CPG verticals. So overall, from a business performance perspective, when we started the year, there was cautious optimism around growth in line with the market momentum at that time. There was obviously signals of reduced discretionary spend and slowdown in some key verticals. We as a company reacted to that uncertain environment with agility and flexibility that was required. And I'm pleased that we've delivered decent growth with good control over profitability. Overall, our annual revenue grew 5% in constant currency year on year and 5.4% in US dollar terms. This growth is attributed to good momentum both in our services business as well as our software business. We delivered a strong growth in our services business. It grew 5.4% year on year in constant currency. And if I'm right, we grew fastest organically in the industry. And HCL software business grew 2.3% in constant currency on year basis. Our company level operating margins in FY24 stood at 18.2%, aligned with our guidance of 18 to 19%. From a booking perspective, we had an excellent quarter. We had $2.29 billion of new deal wins this quarter, and the full year $9.8 billion of deal wins, which is a 10.2% growth compared to FY23. During the year, we had a total of 73 large deals, including 21 of them this quarter across products and services. Coming to our performance by segments, our IT and business services grew 6.2% YOY. ERS grew 1.6%, and the digital content in our growth grew 5.3% YOY, and it now contributes to 37.3% of our revenue. While there was notable growth across various digital business practices, the one that stood out during the year was cloud and cybersecurity. We had phenomenal growth both in cloud migration to hyperscalers as well as setting up hybrid cloud environments for our clients. Software business, as I said, grew 2.3% year on year in constant currency. The business made significant progress this year by focusing on subscription and support revenue, which has increased from 79% to 83% from 23 to 24, and the ARR continues to increase steadily. Now coming to the verticals and geographies, our geography growth was led by Americas, the largest market for IT services, and for us it grew at 6.8% year on year in constant currency, followed by Europe at 5.5%, and ROW, which declined 7.1% year on year in constant currency. Our top performing verticals were financial services, again the largest vertical in terms of IT services spend. Our financial services grew at 12.1% year on year, and manufacturing grew 9.8%. It was aided by ASAP acquisition as well, and retail CPG grew 8.2% year on year in constant currency. The second half of the year, the growth was dominated by the telecom vertical, and Srini and Anil will speak about the success and the state of the market in these two industries. Generally, we are seeing a lot of traction in AI and Gen AI related opportunities, where clients are looking for realistic and pragmatic benefits. We've had a good success in building a strong pipeline because of the successful proof of concepts that we've done with various clients. We are also channeling our internal effort to get people trained on Gen AI to ensure that we are able to deliver the software development in the most efficient way possible. We also recently launched HCLTech's AI Force platform, a generative AI and automation platform that powers a dynamic suite of solutions designed to inject intelligence into every facet of software engineering workflows across development, testing, support, and maintenance. Our headcount continued to grow this year. We added 1,537 people and also added 12,141 freshers in FY21. Our people count at the end of the financial year stands at 227,481. Our attrition continued to trend in the right direction through the year. On an LTM basis, our IT services voluntary attrition is at 12.4%, probably one of the lowest in the industry. In terms of awards, we continue to win several awards from market analysts and advisors as a leader in many service areas. Notable ones beyond the areas we are well known for include SAP S/4HANA services, digital commerce, hybrid enterprise cloud services, where we were recently recognized by Avasant. Also, Ethisphere named HCLTech among the 2024 world's most ethical companies. MCSI ESG assessment kept us at a AA rating for a second consecutive year. And for a second year in a row, we are included in the S&P Global Sustainability Yearbook 2024. Looking ahead, our pipeline continues to grow and remains healthy. Our brand transformation efforts are now giving us the edge from being considered the best kept secret to the best in class service provider. HCLTech emerged as the fastest growing brand among the global top 10 IT services companies according to 2024 Brand Finance report. And I do believe this helps us create greater momentum as we get into this year. Moving on, I believe FY25 would be another year of consolidation from both demand and supply side. Our revenue guidance for FY25, we are guiding for 3 to 5% growth on constant currency, and our guidance for operating margin is the same as last year, which is 18 to 19%. With that, I will request Pratik to share greater details on our financials. Over to you, Pratik.
Thank you, CVK. Hello, everybody. Good evening, good morning, wherever in the world you are. So I'll cover the Q4 numbers very quickly and then go into the main part, which is the full year, financial year 24. For the quarter, the tech, and I will focus on the rupee numbers, given that we are an Indian company listed in India. So focusing on that, so those numbers will be a little different from the constant currency numbers that CVK called out. At a company level, HCLTech revenue came in at 28,499 crores, which is 7.1% growth on a year-on-year basis, obviously in rupee terms. Services revenue stood at 25,790 crores, which is increased 7.9%. Within that, ITBS, IT and Business Services, that grew at 8%, and ER&D went up by 7.4% year-on-year. And HCL Software was up 0.8% for the quarter, year-on-year. At a company level, the EBITDA came in at 6,111 crores, which is 21.4% of the revenue. And on a year-on-year basis, that increased 4.2%. EBIT came in at 5,080 18 crores, which is 17.6% of the revenue, which is up 8.7%. Within the services, IT and business services took the lead by growing at 9.6% year on year, and ER&D was up 4.6%. And HCL software for the full year was up at 5.2% year on year. For the full year, EBITDA is 24,200 crores, which is 22% of the revenue, and it is up 6.9% year on year. EBIT is at 20,000 crores, 20,027 to be precise, which is the 18.2% EBIT, which is increased 8.4% on a year-on-year basis. So we have crossed a significant milestone of 20,000 crores in the EBIT for the year. Net income, which is profit after tax, came in at 15,702 crores, which is at 14.3% of revenue, and an increase of 5.7% on a year-on-year basis. Return on invested capital is a metric we have been monitoring and publishing very consistently for the last few years, and that has improved significantly this year due to our continued focus on both the profitability and the managing the capital efficiency of the company. The last 12 months return on invested capital, ROIC, stands at 33.8% for the company, and that is an increase of 341 basis points year on year, 3.4 percentage points. And services ROIC is at 41.6%, which is an increase of 4.3 percentage points on a year-on-year basis. And software came in at 16.5% ROIC. And driven by all the profitability metrics above, we also managed to reduce our DSO, days sales outstanding, including unbilled revenue. So the DSO now stands at 83 days, which is an improvement of 5 days on a year-on-year basis. In the March quarter last year, it was at 88 days, and now it is down to 83 days. And that has helped us demonstrate a very healthy cash conversion, operating cash flow of 22,448 crores, which is up 25% year on year, and free cash flow of 21,400 crores, which is up 31% year on year. And as a percentage of net income or profit after tax, the OCF is at 143% of the profit after tax, and free cash flow is 136% of the net income, respectively. And our balance sheet continues to strengthen. Gross cash at $3,390 million, $3.4 billion approximately, and net cash at $3.1 billion. So for the shareholders, that basically means last 12 months or the financial year diluted earnings per share came in at 57.86 rupees per share, which is an increase of 5.6% year on year. And the board has declared an interim dividend of 18 rupees for the quarter per share, the record date for which is 7th of May, and the payment date of the same shall be 15th of May 2024. That 18 rupees for the quarter brings the total for the year cumulatively to 52 rupees per share, and which is 90% of the EPS of 57.86. And that's a little higher than the capital payout run rate that we've maintained and the promise of minimum 75% that we had given about 2.5 years back. So that's it from my side. I'll now hand over to Ram Srini for the FS vertical.
Okay. Thanks, Pratik. So I'm going to give some details of how financial services business has progressed. As we set out with the challenger mindset, we focused on three things. The first one was on verticalization of our infrastructure and of our engineering capabilities. The second was to ensure that we leverage the ever-evolving ecosystem to add maximum value to our customers. And the third one was to ensure that we had an outcome focus so that the customers were contractually committed to the benefits that they could expect. Now, in addition to this, we also took a few big bets, three of them, in fact. One was an offering which was on hybrid cloud. CVK already spoke about how that has been one of the cornerstones of what's driven growth this year. And the second thing was on a couple of groups of micro verticals. One was asset and wealth, and the other is insurance and retirements. Now, some of these have already borne a lot of fruit for us as the results have conveyed this year, and some we're developing traction, and hopefully that augurs well for the future. Now, this year, the focus on execution has reaped us very, very good dividends. The 12.1% growth this year is largely on the back of great execution of fairly complex projects that we have worked, largely in hybrid cloud, where we've made sure that the customers have benefited from our expertise in taking them to optimal solutions, whether it is on the colos that they have built or to take them to the hyperscalers based on what is best for business agility. We've also had fairly good growth in different new accounts that we've opened in the last 3-4 years. CVK mentioned about the 5.3% growth in digital engineering. That's consistent with what we've had in financial services as well, even in a time when discretionary spending was not at its best. What this also done is to provide us with new deals for this year and also in this quarter. We've seen a fairly equitable distribution of efficiency engineering deals as well as digital engineering deals, and also a big smattering of data engineering deals where customers are setting themselves up to maximize their investments on Gen AI and what that future will hold. As a function of all of this, our pipeline has been reasonably robust, which also indicates well for how we're going to perform in the years to come. That's the brief on financial services, and I'll now sort of hand it over to Anil, who will cover the other verticals.
Sure, Sri, thank you very much. My pleasure to be with you all today. I want to start by saying very pleased that we've had a very satisfying FY24 year. This is because we have delivered industry-leading growth, which is 6.5% year-on-year in the telecom, media, publishing, and entertainment industry vertical, and 8.2% in our retail CPG verticals on a year-on-year basis. Now, we also executed well on all dimensions, and that is reflected in this revenue growth despite the challenges in these industries. TMPE specifically achieved its highest ever bookings in financial year 24. And that is, of course, the Verizon Managed Network Services deal is a large contribution to this overall historic highest performance in the TMP segment for us. But also what it did is really cemented our credentials in the global telecom industry. Now, with that, we also see huge opportunities for us to also address some of Verizon's global enterprise business customers, which we get them to experience the full stack of HCL services. We also continue to scale our other telecom, media, and entertainment customers by being presented with newer opportunities, and these are led by 5G and enterprise network transformation, driven by Gen AI, of course, enhanced customer experience, data AI, and all this is looking at enhancing different customer value chains. All this is really finally leading to us having delivered in TMPE vertical a 21.6% sequential growth and a 39.2% year-on-year constant currency growth. I think we are sharply focused on having built and having propositions which are in categories that are very focused on value chains that matter the most to our customers, associated with their revenue streams, associated with customer loyalty and experience, associated with simplifying and modernizing platforms which deliver this, and finally, autonomous execution infused with AI and Gen AI. All this is, I think, what is leading to multiple wins, and some of them I would like to share with you today that we have recently signed up. For example, we have a US-based technology major which has selected HCLTech in optimizing its data center using Gen AI. Now, HCLTech's comprehensive data center pre-production validation will rigorously test this infrastructure for compatibility with Gen AI workloads, mitigating risks, and accelerating deployment. Similarly, we have another leading US tech company which has selected us to transform its product validation, sustain experience with Gen AI. HCLTech is going to be leveraging its AI capabilities and frameworks to provide the next-gen tools and services along with the complete life cycle of product engineering, support services. This is to enhance customer experience, reduce cycle times, and of course, optimize cost. There is another tier one mobile telecom company in the US which has selected us as one of their top strategic suppliers for a full spectrum of services. This is from digital transformation, cloud strategy and adoption, infrastructure upgrade, product development, and managed support services across a period of 5 years. We also signed up with a US technology company, which actually has now selected us as their strategic professional services partner. It's helping drive the product adoption, enabling business growth. And what we will be doing is providing them product implementation, cloud migration, site reliability engineering, and many other associated services to their global marquee customers. And finally, we have another US enterprise software provider who has chosen us as their strategic partner and exclusively to set up a Gen AI-powered TAC, which is a technical assistance center, in enhancing the operational efficiency and delivering improved customer service. And I think to summarize, all this is what makes us optimistic about the growth opportunities that lie ahead of us, which is where we continue to invest in newer technologies and innovation that is allowing us to keep our clients ahead of the curve. Thank you. Ram, over to you.
Thank you, Anil. Good evening, everybody. FY24 has been a fantastic year. CVK already covered the people metrics at the annual level. I'll probably add a few more details to that. We ended the year with 227,481 is the people strength. This quarter, we added 2,725 people, and overall, on a full year basis, that's an addition of over 1,500 people net addition, perhaps one of the years where we've sort of bucked the trend to have net headcount addition through the year. This quarter, we also added more than 3,000 freshers. On a full year basis, 12,000. So that program of adding freshers continues through the year. There's been no change to the plan that we set out at the beginning of the year. Attrition this quarter at 12.4%. Again, one of the metric where we continue to trend in the right direction over the last few quarters. So while we talk about matrices, it's also important to look back at the full year we put in a lot of effort and investments in trying to upgrade the number of people practices that we run within the organization, launch a number of new programs. All of this is adding up to the kind of recognitions that we get for the work that we are doing. This year we had more than 12 awards for a number of different things, ranging from being a top employer to diversity to learning initiatives and so forth. The most satisfying one is to be recognized as a global top employer across all the geographies that we operate. Across 21 countries, we are recognized as one of the number one top employer in the ID services space. And these are countries that cover where more than 95% of our employees work out of. So that's a very satisfying year for us. The other significant initiative that happened through the year is to democratize the upskilling program in the organization. We have always been focused on upskilling, but we made a shift to completely democratize the way we target upskilling efforts in the organization. That resulted in nearly 10 million learning hours through the year, more than 160,000 employees, unique employees, getting upskilled and trained and certified in a variety of skills in demand. This was reviewed and assessed by a number of external firms. If I just call out a few things, Avasant looked at the efforts that we put into upskill people on digital skills and recognized us as a leader in digital skills training that we have done. Everest Group rated us as a leader in talent readiness for next-gen skills for IT services. Some of the efforts that we have put into democratize learning and learning journeys that we drive in the organization is reflected in our readiness to serve our customers better in the future quarters. So that's an important call out for this year. One other thing which I would like to call out is back in July, we had to take some difficult choices at that point in time. One of the difficult decisions that we made is to skip a pay review cycle for our mid and senior management colleagues. But looking back at the full year and the performance that we have for the full year, we revisited that decision. I'm happy to say that we decided to include our colleagues in the mid and senior management also through the pay increase cycle, which took effect this quarter. So that's another thing that happened, which is a reflection of the a good year that we had. So that's a brief summary on the activities that has happened in the organization on the people side. We can open the floor for questions.
Siddharth, over to you.
Thank you, Ram. We will now be opening the floor for question and answers. Ladies and gentlemen, in case you are on a computer system and want to ask a question, please click on the raise hand icon on the bottom right of the participant panel, and we will unmute your line. In case you have joined on audio only, please press *3 to raise your hand. And if you experience any technical difficulties, you can message your question using the chat box. Our first question is from Anisha from ET Now. She has messaged in the chat box. The questions are for CVK, Prateek, and Ram. CVK, you sounded fairly confident in Q3. What changed that led to a weak guidance for FY25 now? And the second question is, how much was Conviva contribution in revenue? From 20% margins to sub 18% this quarter, walk us through the margins push and pulls. Going forward, what levers you see for margins? Will Q1 see you come within the guided 18 to 19% band, or will it be a lot more lopsided for H2? And the last question is for Ram. Fresher hiring target for FY25. Will you be going to campuses this year? Thank you.
So I will start with the first question. Thank you, Anisha. On the revenue guidance, we continue to remain quite optimistic about the opportunities ahead of us. From Q4 to as we get into FY25, some of the large deals that we won will move into a global delivery model, and that will have some reduction in revenue. Apart from that, we believe still we have a strong momentum in a lot of areas. Now, when all of that is also factored in with the macro environment, our assumption is will continue to be similar to what we saw in FY24. So factoring all that, we have given a guidance of 3 to 5%. And as you have noticed, in FY23, we had the highest growth in our services business this year compared to everybody else in the industry. This year, again, we have an industry-leading growth. So I think we have a balanced portfolio which will deliver in any kind of economic scenario. We have taken all the factors, and we think we will continue to lead the market in terms of growth. And margins, over to Prateek, and then.
Yeah, CVK, thanks. Hi, Anisha. Anisha, the simple answer to your question is really seasonality in one word. As you know, our software business has a peak in the December quarter, and that is how we were kind of near 20%. And our guidance for the new year FY25 continues to be at the same 18 to 19% band that we had for the previous 2 years. So there's not changing. I don't want to specifically comment on Q1 or any quarter upfront for the simple reason we never do that. And secondly, given what CVK has already mentioned, that there is an impact in Q1 that we are seeing, and therefore I would hold the comment on that. Thank you. Ram?
So, Anisha, as I mentioned, freshers, at least FY24, we continued with our plan. Even Q4, we added more than 3,000 people on a full year basis, more than 12,000 people. That's a kind of range in which we planned for FY24. FY25, we expect it to be along similar lines. Probably 10,000 plus is what we are planning for as fresher addition for FY25. So which means that we continue to pursue our campus programs as well as our fresher hiring programs. The spread across the quarter for these additions will take it for each quarter, depending on how we see the demand move through the quarter. But the full year plan is very similar to what we had in FY24.
One last follow-up question to CVK from Anisha. What will be the impact in Q1 of shift to global delivery model? Thank you.
So, Anisha, I don't think we will call out too much of specifics, but we usually have a certain seasonality in Q1, which is what you would have seen in many of our past Q1s, and we expect it to be a little more than that.
Thank you, CVK. Our next question is from Shavik Das from Mint. Shavik, please go ahead.
Few questions. There were 2 new 100 million plus clients.
Shavik, can you be a bit louder? Your voice is very feeble.
Hi, is this better?
Yes.
Right. CVK, this is for you. There were 2 new 100 million plus clients in the fourth quarter. And yet the overall guidance that we see for next year is, of course, in fact, lower than this year. Is it safe to assume that the execution of deals remains slow even now? And also the BFSI vertical, as well as North America, which is the biggest chunk of the revenue, and which many of your peers have spoken about weakness in, they seem to have grown for you. So could you offer some color in terms of how you are reading the deals situation in these particular markets? And that's about it.
Yeah. So as you rightly called out, North America and financial services, they are the largest IT services spend segments. And as you can see, we have done very well in North America. We probably have delivered a significantly better growth than anybody else. It's also the highest growth for us. So we have very strong momentum in North America. and the same is true in the last year for financial services. And our $100 million clients increased year on year by 3, and that is the reason we've grown 3% sequentially in Q4. And that also contributes to the full year services growth of 5.4%. So that's the revenue that we have recognized over the last 12 months in those clients. So I think there is no correlation between, in fact, all of that has been possible with very strong execution of all the large deals that we won, which includes some of the hybrid cloud transformation and some of the other digital transformation that we are working with our clients. So I think that explains the client categories. And there was another question for you? Or? Okay. Yeah, thank you.
Thank you, CVK. Our next question is from Shivani from Business Standard. Shivani, please go ahead.
CVK, question to you. You said that a lot of traction in AI and Gen AI deals. Is it time that HCL wants to quantify the Gen AI deals that are coming in? Is it possible? Can we look at it? Ram, for you, you did mention that you have reinstated the salary cuts that you announced in June quarter. I wanted to know, in terms of salary hikes on an average, what it would be for the appraisal season that's going to come in.
So on Gen AI deals, I think at this point, its contribution to the overall revenues is very small. So I don't see a point in kind of calling out revenue. And of course, there are multiple dimensions to the revenue. There are a lot of, I see two broad themes where we are seeing good traction. And those revenues may not really come in as Gen AI revenue. There are a lot of clients who have given us the opportunity to implement Gen AI capabilities using our AI Force platform and provide them the software engineering productivity benefits. So that comes with general software development work, and then we don't think it's appropriate to call that as Gen AI. But of course, all of that is influenced by Gen AI. And of the 15 plus deals that we won in this quarter, more than half of them would have had some Gen AI influence in really shaping that particular deal. So at this point, I don't see any meaning in calling out specific revenue, because there are two categories. One is direct Gen AI related revenue, and a lot can happen in the Gen AI influence category. So I think you should look at overall growth, and we will continue to report our digital growth as well, and Gen AI will be part of our digital growth. I think that should continue to give you a good indication on how we are progressing. Was it another question?
Pay increases, if you look at in FY24, in a typical year, we would have done all the pay increases in one cycle. In FY24, we did it in two cycles. We first addressed our larger employee population, what we call as employees in the E1 and E3 bands. So that largely covers about 90% of our employees. So that went through the regular cycle that we do. It's the 10% in the mid and senior management is what we took a decision to skip, which, as I said, given the performance for FY24, we decided to revisit that and include them also in the increases which we did this quarter. In terms of the average increases, it has been in the same range as what we have done in the previous years. So there's no difference to that. It's always a case of how we treat our top performers. Our top performers continue to get double-digit pay increases, and that has also been the same as what it has been in the previous years. I think your question also included what's the outlook for FY25. We're just coming out of FY24, and our pay increases cycle typically are through the mid-year and the later part of the year, so that we will plan for as we go through the year. So I don't have any specific guidance to give for that, because that's at least a couple of quarters away.
Thank you, Ram. Our next question is from Beena from Economic Times. Beena, please go ahead.
So what exactly would be the subcontractual cost given the whole attrition is, weaker and it has reduced further? And if you could just give us a sense on contractual hiring going forward, while you mentioned a bit about fresher hiring. And what was the target for fresher hiring last year?
Ram?
So, Binal, there are two parts to your question. One is on the freshers, another is on the contract hiring. Since I've already spoken about the freshers, I probably touch on that. When we started at the beginning of the year, we were targeting about 15,000 odd freshers on the ballpark. That was the go-in plan for the year. We finished with more than 12,000. Given the volatility that we had through the year, we had to recalibrate our fresher hiring. So that's broadly close to the plan. So there's not been a significant shift to that plan, which is what we expect to see in FY25 as well. So far as contract hiring is concerned, it is always very tactical in nature. It is all driven based on how the demand is fulfilled internally. Only where we cannot meet demand internally, we make a tactical call for contract hiring and contract fulfillment. And during the course of last year, we did see a drop in the need for contract staffing, and that shows up in the spend as well for contract staffing. Looking ahead into FY25, our approach is going to be the same. Our approach is going to be more focused on internal fulfillment, and we build a capacity for that, and we invest in our skilling efforts to meet that goal. So contract staffing will continue to be tactical in nature, and it's just going to support the demand that we cannot fulfill internally. So that, as I said, as an approach, that will continue.
There is one additional question from ET team for CVK and Prateek. The question for CVK is, you have backed 73 large deals in FY23, in FY24. Will that put more on-site employees and put pressure on margins this fiscal? And for Prateek, could you throw more colors on the dip in margin, though we know that seasonally factor played a role in Q3? Thank you.
I think the deal wins and on-site employee count, I don't think there is any direct correlation, because most of the solutions that we build in all our large deals is a global delivery and global execution from onshore, nearshore, and from India. So I don't think there is any direct correlation. And first of all, a lot of deals that we have won in FY24, most of them have been already executed, or they're probably in the final stages of execution, especially the deals that we won in the previous quarter. Only that will kind of provide the momentum in the coming quarters. So the second question, over to Prateek.
Yeah. On the margins, I think, you already referred to the seasonality, which I talked about earlier. So if I look at just the services part, which does not have the seasonality, which is basically in the software business, that is a decline of about 70 basis points. And there are two main points in that. About 50 bips is basically because of the increments. So Ram talked about the extra increments that we gave beyond what we had planned and actually announced publicly. And there was some small forex also, which leaves the balance as all other things put together. So there's not much that to really explain there. Thank you.
Thank you, Prateek. The next question is from Debangana Moneycontrol. Debangana, please go ahead.
Hello, gentlemen. My first question is to CVK. CVK, rest of the world or emerging market revenue has been declining. The company just announced a deal with State Bank of India. So do we expect the emerging market focus to increase as well in FY25? What's the outlook there? Um, and I have a question for Prateek. Prateek wanted to understand what levers are in place for margin improvement in FY25, because even your peers like TCS and Infosys's management has been talking about price hikes could possibly be one of the key metrics to improve operating margin in FY25, given the ongoing inflation. Is that something even HCLTech will be looking at? I had a question for Ram. Ram, you just indicated that fresher addition would be similar to that of FY24. So can we say it's going to be in and around 12,000?
A lot of questions, so let me get started. First is ROW. Yes, our revenues declined in FY24, but our outlook in FY25 is very promising for ROW, and we continue to enhance our focus in ROW, which is what we call as rest of the world, which is emerging markets. So you should expect to see good growth in rest of the world for us. And State Bank of India is a deal that we announced. Of course, it was not a last quarter deal. It is a deal which we signed in the last few days. This is HCL software program where we will be our MarTech stack, what is really driven around HCL Unica platform, is what we will leverage to deliver customized experience for the bank customers. And this is a very transformational program at a very, very large scale, probably one of the largest scales in the world. And we are really proud to be a partner for SBI in this big transformation program, powered by HCL Unica software platform. And I'll hand it over to Prateek on the margin levers and the price increases.
Yeah, sure. Debangana, on the levers, we have pretty much all of the typical levers available, and starting with the utilization of the employees, followed by pyramid and the average resource cost. As we continue to invest more in the fresher intake, that helps there. Of course, offshoring of the work, especially the fixed price projects and managed services is another lever, followed by automation and all the other levers that are associated. On your specific question on price increase, while we continue to see, even in this year, some improvement in realization, I don't think I would really call it as price increase per se. It is more about, delivering the same work with lesser people and doing a more efficient job, which makes the realization go up. So I'll leave it there, unless CVK.
Fresher addition, Ram can answer.
Freshers?
Yeah,
we've already. Okay, go ahead.
Yeah, Debangana had a question about freshers as well. So for FY25, our go-in position is about 10,000. The more important thing to look at is how do we prepare for that and how do we plan for that. So the off-campus cycle that we did in the last quarter, we have more than 10% of the plan for next year coming through that. The campus cycle for this quarter, we have already released offers that covers for another 15% of the plan that we have for this year, and that campus cycle is still continuing. So if you look at the readiness to meet the numbers for this year, we are quite prepared for that. So the going position is that we'll look for 10,000 plus for FY25.
The next question is from Sai Ishwar from Reuters for CVK. Does 3 to 5% guidance include ASAP acquisition and State Street divestment? What does shift in global delivery model mean? More offshoring? Thank you.
Answer is yes for both your questions. Our guidance includes ASAP acquisition numbers and the State Street divestment numbers. And one part of the global delivery model is offshoring. Thank you, Ishwar.
The last question is from the line of Rucha from NDTV Profit. The questions are for CVK and Ram. What kind of deals are you getting? Are clients incorporating discretionary spend? What is the outlook on macro? For Ram, what are your plans on work from office? And what impact for you are from expectations of delayed rate cuts? Thank you.
Yeah, on the deal types, I think, of course, there is a much greater emphasis on efficiency-led opportunities in the market. And a lot of efficiency-led opportunities also requires technology transformation and digital transformation. So we are seeing a combination of transformation-led cost efficiency type of opportunities. That's what is predominantly in our pipeline. And we are also seeing in some verticals, we are seeing transformation projects, which you would typically call it as discretionary spend. But they're all very, very business focused and ROI focused transformation programs that some of our clients are embarking on, where we are partnering with them. Otherwise, broader macro continues to be quite volatile, and we are cautiously optimistic, and we assume a similar macro environment that we saw in FY24 to be also there for predominant part of FY25, and that's what our base assumption in our guidance is. And on work from home, I'll request Ram to provide more insights.
Our approach to work from home or work hybrid, we've always talked about taking a very balanced approach. Over the last 1 year, we continue to hold the policy of hybrid working as our preferred model. We have started getting our colleagues back to office on a 3-day work from office basis. So that's the hybrid work arrangement that we have. If you recall, when we first talked about hybrid working arrangement, we said that it's our mid and senior management which will start coming back to office on the hybrid model, essentially to set an example for everybody else in the organization. And then we gradually progress that to include all employees to be on the hybrid work arrangements. That's our policy, that's our approach. We continue to take that approach. Having said that, there are client commitments to meet, and those will be governed by what we need to do to meet specific client deliverables. Again, if you look back in the last 1 year when I've talked on this subject, I've always said that we have not adopted a top-down from the center kind of a mandate going out to everybody to follow something. We have said that there's a corporate guidelines, and the decisions are localized, and managers are empowered to make their decisions within the corporate guidelines so that they can take into account their client commitments and how their client commitments are met. We always monitor productivity, and we continue to believe that we are able to deliver the productivity that we need to within the approach that we have taken. So our approach is going to be the same. We did make a careful choice not to take a punitive measure as an approach to encourage people to get back to work. We've always taken an approach to show value to people as to why it makes sense for people to come back to office, spend a few days in the office, get assimilated with the culture in the organization, and build their career through that. So it's more a positive approach to encouraging people back to work as opposed to any punitive measure. So that approach continues to be working well for us. We'll continue with that.
Yeah.
Thank you, Ram. Yeah. Thank you, Ram. We have no more questions.
Okay.
Thank you, everyone, for your valuable time and presence. Please note that the recording of this the HCLTech website. With that, we conclude this press conference. Thank you once again for joining us. Stay safe and take care.
Thank you.